Bitcoin's biggest correlation is with global liquidity, and it follows global liquidity better than any other asset. So better than stocks, better than gold. And there's a couple of reasons for that. One is stocks obviously have other variables, things like earnings, that can impact their pure correlation with liquidity. Gold it doesn't have those earnings, but it does have some risk-off aspects to it. So sometimes in a worsening liquidity environment, gold can actually catch a bid just because people want to get out of other things. Bitcoin has the highest correlation directionally with liquidity. I'm fairly bullish on liquidity with a 12-month view.
Alden references research by Sam Callahan, which compares Bitcoin's performance with global liquidity. The results show that Bitcoin's correlation with global liquidity surpasses that of stocks, gold, and other traditional assets. She emphasizes that Bitcoin follows global liquidity better than even equities or commodities like gold because it lacks earnings or inherent cash flows that influence the pricing of other assets. When global liquidity rises, Bitcoin tends to perform well, and when liquidity contracts, Bitcoin faces downward pressure. Alden explains that liquidity can be measured in several ways, including through M2, broad money supply, and proprietary metrics like those used by Michael Howell at Cross Border Capital. Alden's analysis of global M2 denominated in dollars reveals that Bitcoin is uniquely responsive to fluctuations in global liquidity. The two main components affecting global liquidity are the pace of credit creation and the strength of the dollar. A weakening dollar can boost global liquidity in dollar terms, leading to a positive impact on Bitcoin.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I think most pools of capital treat it as a risk-on asset. Obviously, there are people that are very enthused with the fundamentals and then know that you can hold your own money and move around the world, and so it's got those risk-off properties. But in terms of pricing, most pools of capital treat it as a risk-on asset. I actually so I worked with Sam Callahan. I commissioned a research report from him, and he wrote this report. It's on my website now, that maps Bitcoin to measures of global liquidity. And we found that Bitcoin's biggest correlation is with global liquidity, and it follows global liquidity better than any other asset. So better than stocks, better than gold. And there's a couple of reasons for that. One is stocks obviously have other variables, things like earnings, that can impact their pure correlation with liquidity. Gold it doesn't have those earnings, but it does have some risk-off aspects to it. So sometimes in a worsening liquidity environment, gold can actually catch a bid just because people want to get out of other things. Bitcoin has the highest correlation directionally with liquidity. I'm fairly bullish on liquidity with a 12-month view. So there's a couple ways to do it. Michael Howe of Cross Border Capital has a more proprietary method of measuring global liquidity. We used global M2 that's denominated in dollars. And so basically there's two components there. One is the pace of credit creation, so the pace of more M2 units, broad money hitting the market. And then the other one is what is the dollar index relative to those. And the reason that's relevant is because so much debts internationally are denominated in dollars. And so the dollar kind of weakening can make global liquidity go up in dollar terms, which are relevant relative to their leverage units.
Right. Okay, so it's done on M2, not M0.
Yeah, M2, broad. And so my base case is, we've been in this consolidation. I think we're probably going to grind higher in the next 12 to 18 months in global M2. And I think, and when you look at various measures of valuation, I think that Bitcoin probably grinds higher in that time. Is my kind of base case.
And what's your base case for NASDAQ slash tech stocks? And I use that as a proxy for growth stocks. What is your proxy the same, that they're a function of global liquidity? Or
yes, I'm a little more concerned about those because in addition to being correlated with liquidity, related to the state of the economy and their earnings and their revenues and consumer strength. So I do have concerns about the Teslas, the Apples of the world at their current valuations, and even Nvidia. As much as I think that they're going to keep selling more and more GPUs, I think you can go through pockets of softness where a lot of entities bought all these GPUs that are not making money from them, and they can scale back their purchases for a period of time until they kind of figure out how their business model is going to work. And so, I don't really have a high conviction view on these big tech stocks, other than that I don't love the risk reward at these valuation levels and this kind of state of economic softening. And if anything, they're treated like they're actually more treated like risk off assets, which is people say I don't know what I want to own out there, but I don't want to own commercial real estate and I don't want to own cyclical things. So I want to buy Apple and I want to buy Nvidia and I want to buy these big cash rich, entities that are super profitable. And if anything, there's already a lot of capital stuffed into those, which concerns me. So I've been using the 3-pillar portfolio, which is one pillar is equities, another pillar is cash equivalents, things that are kind of protect you in one of those like liquidity risk off cycles, and then the other pillar is commodity producers and sound money that can do well in debasement and inflation cycles. So you have this kind of protection from different scenarios. My base, and to George's point, I think it largely depends on whether we get a liquidity pocket or not. My base case is that we've probably already seen a liquidity pocket, and that I kind of view this more like that 2001 cycle. But you can only be so sure about that type of outlook. And so I think that we kind of, a lot of these other assets probably over time grind sideways to up in this scenario. And if we do get a recession, I would think that, in any sort of liquidity pocket, most assets go down. And if you don't get a liquidity pocket, then I think that basically things with earnings struggle. Whereas things that don't have earnings, like gold and Bitcoin, that are more like responsive to liquidity, they probably do pretty well.
So how do you position yourself? Yeah. How do you break down? Let's just take a $1 million portfolio. How do you break it down? Where do you put the money?
So it depends on your risk tolerance. I put a lot of it in equities, a good chunk in gold and Bitcoin, a decent chunk in that kind of energy producer category, and then a smaller chunk in cash equivalents, things like short-term treasuries, money markets, T-bills.
What percentage?
Short-term tips.
What percentage, under the fact that you're, relatively risk, that you're willing to take relative risks at the moment, what percentage would you be invested? What percentage would you be in cash and cash equivalents?
So for me, I have something like 15 to 20% in those cash equivalents. If I was obviously near retirement, I'd probably dial that up to some extent. But this comes down to whether or not someone's a high turnover trading portfolio or a more strategic evergreen portfolio. Mine is more evergreen, so I only make small marginal adjustments. Like I lean a little bit toward risk, or I lean a little bit toward risk off, rather than making these big sweeping changes about what I expect to occur over, say, the next 12 months.
Alden closes with an analysis of the broader liquidity environment, highlighting the role of the Federal Reserve, Treasury General Account, TGA, and reverse repo operations in shaping the money supply. Since the regional banking crisis in 2023, liquidity has plateaued, and Alden expects this flat environment to persist until the Fed begins to gradually increase its balance sheet by 2025. She draws parallels to 2019, when the Fed took similar actions following a repo market spike. Although liquidity is expected to rise, it may not happen at a rapid pace. Alden warns that bank lending has been tightening, contributing to the complex dynamics between fiscal and monetary policies. This divergence could create conflicting signals in the economy, making it harder to predict whether we are headed into or emerging from a recession.
Money supply bottomed in 2023 and has been slowly grinding up, partially because we have kind of the Treasury offsetting the Fed. Active Treasury issuance is how some economists like Nouriel Roubini have described it. Basically, the shortening of the issuance of extra T-bills, the draining of their reverse repos. So when you kind of take a more aggregate picture of both the Fed balance sheet and then these other components that are out there, the TGA and the reverse repo facility, we've kind of been in this flat liquidity environment ever since let's call it the regional bank crisis of 2023. That was kind of a pain point We started kind of going sideways rather than down after that. I expect that to probably continue until we reach the end of the reverse repo facility, and then the Fed already projects that by the end of 2025 they would probably go back to gradual balance sheet increases, not for stimulus purpose, but kind of like they did in 2019 with the repo spike that they went through. They would basically say that we've reached the bottom of ample bank reserves. We want to start going up in bank reserves and maintain ample bank reserves. I think that's the language that they're going to use to frame it. And I think that we're kind of entering that period of money supply is going up, but not particularly fast. And that probably lasts.
You got to consider the banks too, because that in and of itself, to your point, would definitely increase M2 if they're buying from non-banks. But if the rate to which the banks are lending is decreasing more significantly, then it's still going to go down. So it's definitely, you got to take a holistic view, I think is my point.
Yeah, and the bank lending component's a big deal. And that what I talked about before is that we went through this kind of tight cycle where if you look at senior loan officer surveys, most banks were very conservative. They were basically saying we're tightening all of our standards. And now they're tightening less than they were a year or kind of 2 years ago. We kind of went this kind of 2022, 2023 cycle. They went through this tightening cycle. There's actually evidence that they're loosening up a little bit. And that's why we have these kind of weird components. Like, some metrics say we're headed toward a recession. Other ones are saying we literally just had a recession and we're merging out of it. And it's because you have this kind of divergence between fiscal and monetary policy and this private sector versus public sector situation. Even if you look at asset positioning, for example, Costco is trading at like 55 or 56 times earnings, right? People are not piling into the ARK stocks. They're not piling into Bitcoin. They're not piling into small caps. Most of the kind of the enthusiasm in the market is actually toward fairly defensive things. These blue
they're selling Louis Vuitton and they're buying Walmart. Walmart's going vertical. Costco's going vertical.
Yeah, but growth is not going vertical. Yeah, but growth is not. I mean, as you say,
growth isn't. Yeah.
Yeah.
So I think my point is that basically we already in some ways are positioned like a recession. The credit cycle we kind of went through, and the positioning in these kind of defensive assets. Well, a lot of that's already in treasuries. When you look at what money market funds hold, they hold T-bills, they hold really short-term, high-quality commercial paper, and then they hold reverse repos, which are practically like treasuries. These kind of this like nominally risk-free yield. There's kind of a ratio issue right now between big banks and money markets. So if you hold your money in Bank of America, you're getting paid roughly something that rounds to zero in interest because the top 10 banks have like half of the deposits out there. There's like 4,000 banks, but like half the deposits are in the top 10. Those are the ones
that are lowest interest rates.
Yeah, they're the ones that are not paying anything because they have no risk of a bank run or very minimal risk of a bank run. Whereas like the credit unions of the world are the ones paying you 3 and 4%. And so if you're a customer at these banks, you say, well, I got to have some money in my checking account for liquidity, but I'm going to put the rest in money markets and things like that. And that's why there's this flood into this. And this is already basically treasury or treasury-like assets. It's already in there. I think that basically that's actually another sign of kind of people going through a recession, which is basically people saying, I want to own these kind of conservative things. I think that what happens when rates go down is probably that modulates a bit, which is that you have a smaller delta between what Bank of America pays you and what money markets pay you, and some of that can drain back into the Bank of Americas of the world, or at least there's fewer people clamoring to get out of the Bank of Americas into these money markets, and so you get a little bit of a reabsorption, I think, into banks.
Lyn Alden's expert analysis sheds light on the intricate relationship between Bitcoin and global liquidity. By understanding how liquidity cycles affect different asset classes, investors can better position themselves for future market movements. Whether it's navigating the risks of tech stocks or capitalizing on Bitcoin's responsiveness to liquidity, Alden's insights offer valuable guidance for those looking to build a resilient portfolio. As we look to the next 12 to 18 months, monitoring liquidity trends will be essential in determining the direction of Bitcoin and the broader market.
Please like and subscribe my channel.